Hi, I'm James Robinson, and this is my stock pick of the week. My goal when I created this blog is to create a community of people who are interested in value investing. A place where we can openly trade ideas and give each other advice. I don't claim to have all the answers, though I feel like I've done my share of homework. So if you like the blog or find it interesting, please drop me a note in comments. Of course, subscribing and liking are also great as they help me get exposure and build a community. Thank you for watching. My pick of the week is simply a stock that I think represents a great buy that week. My criteria for what makes a great stock is very simple. I look for great companies with a durable competitive advantage and/or extremely good returns on invested capital. Only after I find companies that qualify under that criteria do I look at the stock price to see if they're fairly priced. My definition of a great company and a durable competitive advantage come directly from my study of Warren Buffett and the various investors in his orbit, people he would call the super investors of Graham and Doddville. It starts with the book Security Analysis written by Ben Graham and David Dodd. What I do not do is look for the next great thing. I love Tesla, but not its stock. I'm sure there's a solar company or self-driving car company or super duper gadget company where a $10,000 investment today could make me a billionaire in 6 months. But I don't know how to find those, so I don't look. I simply look over and over again at company after company, looking for companies that are great. Then I watch those companies for when the stock prices become attractive. That's all I do. Thank you for watching. Hi, I'm James Robinson, and this is my stock pick of the week. Today's pick, Usana Health Sciences, symbol USNA. Usana Health Sciences develops, manufactures, and sells science-based nutritional and personal care products, primarily to reduce the risk of chronic degenerative disease. It also provides Sense of Beautiful science products, such as personal care products that support healthy skin and hair through topical nourishment, moisturization, and protection. It sells Celavive, a skincare regimen for various skincare types and ethnicities, and other products for prenatal, infant, and young child care and groups. In addition, the company offers materials and online tools to assist associates in building their business, as well as in marketing products. It offers its products directly in the Asia Pacific, the Americas, and in Europe. Usana Health Sciences was founded in 1992. Its headquarters are in Salt Lake City, Utah, and it has 1,911 employees. The company's market cap is $1.462 billion. Its revenues are $1.17 billion. The profits are $121 million. Its PE ratio is 12.67. It pays no dividend, which I don't like, but it pays no dividend. It has debt of $18 million, which effectively is debt of zero. It's a couple of months' income to pay off all of its debt, so it has no real debt. So as we talk about every week, I grade companies on 29 categories. I grade them on a scale of 1 to 4. The categories are operating. Operating basically is how well the company delivers goods and services to its customers. Financial, that has to do with how well a company handles risk and how much debt they have. And management, which is how well the company does in terms of returning wealth to the shareholders. Usana is one of the best companies I've rated. Its total average score is 3.41, which is easily in the top 10%, just about in the top 5% of the companies that I look at. So whenever we have a company that performs that well, that we can buy at 12 times earnings, that's really appealing. And that's the reason that we're interested in this company today. As always, we're starting our analysis with gross margins. The reason I start with gross margins is one of the things we're looking for is consumer monopolies. We're looking for companies that have competitive advantages or that have products that have pricing power. The last thing you want is to be invested in a company which is effectively a commodity and it's at the whims of the market. We want companies that people will pay extra for, that have a place of mind in the consumer's consciousness. And one of the ways you look for that is companies with high gross margins. The other thing that's important about high gross margins is the company can make some mistakes and still be profitable because their margins are so high. So when we look at this company, you can see that the top 25% of companies, this company is clearly in the top 10% of companies. And as a result, it's just a fantastic company for gross margins. This is a really compelling attribute of this company. And as you'd expect for a company with significant gross margins, they have significant earnings as well. Companies' earnings have gone up pretty dramatically since 2001. And really they've had 3 down years. And those aren't years they lost money, it's just years they didn't make as much money as they made before. But we've had 3 down years since 2001. That's a pretty good company. And the trajectory is parabolic straight up. So this is a company that we love. Another issue that we look at is net earnings as a percentage of revenue. This is how good a job the company does in terms of taking gross revenues and converting them to profits. And this company's in the top 25%, so it's a solid company. It's not a fantastic company in that aspect, but it's a solid company. When you see, by the way, companies that have extremely high gross margins and then, relative to the market, lower net earnings as a percentage of revenue, that causes you to take some concern and go, well, wait a minute, if they're not hemorrhaging money through cost of goods sold, then where is the money going? So when you see that there's that discrepancy, which there is in this case, we need to look at this company more and figure out where those monies are going. And so that comes back to the next couple of slides where we talk about our 4 taxes that every company has to pay, and some companies have to pay more. And let's see if that's the cause why these net earnings are lower than we'd expect based on the gross margins. So selling and general administrative, you can see that they are a solid company. They're in the top, 25% of companies. They're not in the top 10% as they are in gross margins, but in the top 25%. And more importantly, see that number is very, very constant. They seem to be doing a good job of managing their costs and keeping their costs under control. And we have no reason, if these costs were increasing over time, that would be a concern that their management is getting kind of lazy. But these costs look like they remain pretty consistent, and so no cause for concern there. The same thing is generally true in terms of plants and equipment. You can see it went up a little bit a couple of years ago, but now it's on the way back down. But again, relatively consistent. And if you look at from 2008, you can see those costs have gone down pretty dramatically. So they're not in the top 10% in plants and equipment. In fact, they're sort of very average in plants and equipment, but it's controlled and it's consistent. And this is exactly one of the reasons why we talked about its ability to convert net earnings is higher than we'd expect, because they have higher costs for plants and equipment than a lot of other companies. So the next one is inventory as a percentage of revenues. And you can see that really since 2015, this number has sort of been inching up, and it inched up significantly in 2018. Whenever you see companies that have upticks in inventories, that leads you to believe maybe sales have slowed down. It might be that they are not managing the sales chain as well as they could be, but it might also be that their sales have slowed down. Now, we're not seeing evidence of that anyplace else, but I don't like to see inventories increasing. They're barely in the top 50% of companies. And again, this is another reason why, even though they've got fantastic gross margins, their return on their net earnings as a percentage of revenue is not as high as we'd like. In terms of R&D, the company has none, and so that's obviously as good as it can get. Nothing here really scares me, but it does do a good job of explaining to me why this company doesn't have fantastic net earnings relative to gross margins. So for interest expense, the number isn't zero, but it's effectively zero. They have $18 million of debt that's a company with $120 million in annual profits. So the debt is really sort of insignificant. There's going to be a little bit of interest associated with that, but it's also insignificant. We're well below our goal. We're less than 1% of operating income is going to interest, so it's not a problem. You see the interest expense kind of looks like it bounces around, but if you look at the scale, it's less than $1 million a year. It's a nothing. By the way, another nice thing to think about, we've talked about the fact that they've had something between $0 and $1 million a year in interest expense. The good news is the company last year had almost $5 million in interest income. So they've got money that they've got invested in from cash and marketable securities, and that money is throwing off $5 of interest income for every dollar of interest expense. So the interest for this company is effectively negative. So it's fantastic. So we have nothing to worry about on that aspect. Here we see an analysis of our debt. Our total current liabilities are going up, but if you can see that chart of those liabilities, they're going up less dramatically every year than the income is. That's fine. I don't really mind total current liabilities that are increasing, especially when a company is growing its revenues and growing its earnings. Current liabilities are simply costs to operate your business this year, and as you grow your income, you almost always have to grow some of your costs. Again, this shows you the company's really had no debt since 2010. I mean, again, a tiny little bit, but an insignificant amount. So very, very solid in terms of debt analysis. Year's income to pay off long-term debt, it's less than a year to pay off long-term debt. It's a couple of months. So this slide is, again, this is a slide which is important to analyze for a lot of companies. But when we start looking at companies with no debt, it's almost a waste of time to bring it up. this slide's pretty funny. So if you look at this slide, interest coverage ratio, it looks like, boy, it's really dropped. In 2012, it was way up there, and it's kind of dropped, and it's precipitously close to the red line, which is sort of our goal. But if you look at the scale on the left-hand side, you see that they were at one point 120,000 times the minimum interest coverage ratio that I like to see, and now they're something like 6,000 or 7,000 times where they should be. Again, it's one of those things that if you don't understand the scale and what they're really doing, these slides can kind of get away from you. But there's so little interest being paid relative to the earnings, and there's so little debt relative to the value of this company that I almost wish I could just say it has no debt, but that wouldn't be accurate, so we've got to go through this a little bit. So cash and marketable securities, believe it or not, this is a cause for concern for me. You can see that they're closing in on $300 million in cash and marketable securities. Since 2008, it's gone up pretty dramatically from less than 25 million. There's no good reason for this company to be keeping this much money. I don't understand why they're not paying. This company pays no dividends, and I don't understand why they're not paying dividends. They have the cash. They're not doing a great job of investing. It says, we talked a minute ago that the company is able to throw off $5 million of interest income, but that's $5 million of interest income on $200 million of debt. That's 2 or 3% return on investment. I don't want my companies holding this much cash that they don't need if they can only generate 2 or 3% return on investment. I want them returning this money to us. So this is one of the areas where, even though it looks like this is a good chart and it looks like the company's doing great and got lots of cash in the bank, they frankly have too much cash in the bank, and I want some of my money back as a shareholder. Further evidence of the fact that they're holding too much money is the fact that there's an ever-widening gap between their current assets and their current liabilities. So their current liabilities for a company is costs that they have to pay in the next 12 months. And current assets is cash and receivables that they have on hand. And there should always be a gap. I like companies that have a sensible gap between current assets and current liabilities, but not only is this gap significant, it's more than $100 million, it's almost $200 million, but the gap is growing and getting wider and wider. And on top of that, the current liabilities are relatively flat for the last 4 years. So this is an example of, if I was an activist stockholder, if I was a Carl Icahn or a guy like that and I had the influence, I would use that influence to get this company to release some of its funds to us. And in today's day and age, there's no secrets, right? So my assumption is that as a stockholder of this company, I can assume that sooner or later people are going to start really working this board to give me some dividends. And when they do, I think the value of my stock is going to go up, both because I'm now getting the value of the company and I'm getting dividends. And because once this company starts paying dividends, I suspect that the universe of buyers for the stock will grow, which will increase the stock price. Either that, or they're going to have to use this money to buy back shares, which is, to me, the same thing as dividends. But that's my big problem with this company, and I think there's evidence to believe sooner or later the market's going to, exert its influence and get this company to do that. So we haven't talked a lot about retained earnings in previous videos, but so a company has only several things that they can do with their profits. They can use that money to pay down debt. This company has no debt, so they can't do that. They can use that money to pay dividends. This company is paying no dividends. They can use that money to buy back shares. And this company has done a lot of that, and it looks like they'll continue to do that, which is good. And the final thing they can do is retain the earnings for their operations. So if a company's going to retain their earnings for their operations, we want to have a sense for what good things they're doing for the shareholders with that money. And so the way that we sort of look at that, or the way that I look at that, and it's not super complex and it's not completely accurate, but it's a good place to start, is I simply say, how much money have you retained over the last 10 years? And how much have earnings gone up over the last 10 years? And I, for better or worse, directly attribute that return, those increased earnings, as a return on investment for retained earnings. And so you can see here that, with the exception of a bump of a couple of years, this company's retained earnings have been pretty constant, and they've grown the earnings significantly. And so from that, I'm able to deduce that this company is getting fantastic returns on retained earnings. And to the extent they're able to continue to do that, I love this company, and they're doing a better job with my money than if I got paid the money and had to reinvest it. I don't think I would get 300% a year on that money, as you see in these slides, or 500 or 900%. I think that the more money they hold in cash and market securities, the harder it's going to be to continue to achieve these results. It's going to start to degrade them. But for right now, I'm willing to give them a long leash. I love companies that can do a great job of retained earnings because it just means I don't have to go manage the money. And it also means that I'm getting that benefit in an after-tax way. Because if I get paid dividends, I've got to pay taxes on those dividends. If the company keeps those profits, I don't pay taxes on the dividends. And so, I'm not horribly upset that the company's keeping money because I see these retained earnings and return on retained earnings are so great. So you can see this company's done a great job of buying back shares. In 1999, they had about just under 50 million shares. Today, there's just under 25 million shares. So in 20 years, they bought back half the company. They bought back about 35% of the company since 2008 in the last 10 years. It looks like the last 2 years, the amount of shares they've purchased have slowed down, which is cause for concern because they're hoarding so much money. But in general, I give these guys a long leash, and we'll see how they do over the next few years with this. Again, I'm a very long-term holder of companies, and I don't get too wrapped up in what they do in any 12 or 18-month period of time. But I'd like to see this thing returning. I do think this is one of the reasons that the stock price is down is because investors are starting to wonder what's happening with this money, but I'm comfortable with it. So to put the share repurchases in context, if you'd owned 10% of Usana stock at the end of 2008, you would have owned about 3.2 million shares. Today, through stock repurchases, your 3.2 million shares would mean your ownership in the company has grown from 10% of the company to 13.3% of the company, so about a 33% increase in your shareholdings. In addition to that, your share of the company's earnings would have gone from 3.36 million to 16.81 million. So if you'd bought 10% of the company 10 years ago, that 10% of the company meant you'd have your share of $3.36 million in earnings. And without investing another penny, you'd now be getting your share of 16.81 million in profits over those 10 years. So it's a company that's managed to grow its earnings. It's a company that managed to buy back stock. That's the way this company is enriching its shareholders, and they're doing a great job of it. This is the slide that I don't like. I don't hate it because I know what's happening with retained earnings, but I just don't like companies that don't pay dividends. I think that companies should have some obligation, some goal to pay back money to the shareholders directly through dividends. Now, having said that, my idol, Warren Buffett, has had Berkshire Hathaway in since 1965, has never paid a dividend, and that's worked out okay for him and his investors. But I just can't count on every company being Warren Buffett and being Berkshire Hathaway. And I'd like to have the money back in the form of dividends. Also, as a shareholder of the company, I like it when there's lots and lots of people who might like to own my company. And when you pay no dividends, there are a lot of investors who simply won't buy your stock. And so I think it's sort of an unforced error to not pay some dividends and thus increase the number of people who will be out there competing for our shares, creating additional supply and causing our share price to go up. So that's my thoughts on dividends. Now, typically, as you know, I look at dividends for four factors: in dividends in terms of yield and growth, in terms of their safety for context of earnings, dividend safety in the context of cash flow, and dividend safety in the context of current debt load. Obviously, I'm not doing those 4 slides today, simply because there's no dividends. But we'll go back to that when we go to dividend-paying stocks. So as you would expect, when a company is hoarding cash, their shareholders' equity would be increasing, and you see this company is increasing. It wouldn't bother me if this was flatlined for a few years and they started returning money to us. Wouldn't even bother me if this was to go down a little bit and they use some of that shareholders' equity to buy back shares and pay dividends. But this is the chart that we've got since 2008. The company's gone from shareholder equity of 50 million, call it, to today it's 400 million. That's a good thing for shareholders. I just think it's perhaps not the most efficient use of our funds. This slide almost forgives everything for this company. I like companies that get great returns on assets. The fact that they've been hoarding money for the last few years and the return on assets continue to remain, above 18%, I almost don't need to see anything else. This company does a great job. The management does a great job of holding my money, using it intelligently, and creating returns for me as a stockholder. And while I wish they would do things a little differently, when the things are working, you don't try and fix it. You don't try and fix what's not broken. And so look, if these guys were just able to continue to hoard money and continue to generate 18% returns on the money they hoard, the stock is going to go to the moon and it's going to be fantastic. So all is forgiven because of the return on assets. And when you look at the next slide, return on equity. They're in the top 10% of companies in return on equity, and they're in the top 10% of companies return on equity, and they're doing that with no debt. And that's just even more fantastic. So these two slides, sort of everything I've said that are concerns and things I'd like to see the company do better, these two slides sort of say, James, shut up, buy the stock. And so that's what we're suggesting you should do. So in summary, the first question I like to ask about a company is, does it have a consumer monopoly? I really don't think that it does. I think that its products it's in a pretty crowded market. There's not a lot of, not a lot of blue water. It's a red water. If you've read the book, Blue Water Strategies, there's a lot of competitors out there. I don't know what these guys do that's so special. The one thing that they do is they're like Amway. They sell direct through, housewives and, kind of people's second jobs. And they seem to have figured that business out. I don't generally love that business. I think there's a lot of really shady things going on in that industry, but this company seems to do a good job with it. And that maybe is what their consumer monopoly is, but I don't think their products are necessarily that much different than other vitamin companies. But then again, Coke isn't that much different than Shasta, and it works because people just like it. And I can't say that I'm a user of these products. I don't have a real sense, but the financials are great. That's why I like the company. I don't like the company because it has some significant and observable competitive consumer monopoly. The company has virtually no long-term debt. In fact, we're just going to call it no long-term debt for now. The company does reward its owners, but only indirectly. The company pays no dividends, but it has repurchased about 33% of its stock in the last 10 years. It has it has an extremely high return on retained earnings. So in my mind, it's earned the right to continue to retain earnings with a minimum amount of grumbling from me. The company's earnings have been generally increasing every year since 2001. They've gone up. They've never had a down year where they've lost money, and only 3 of the last 20 years have they not increased their earnings over the year before. So would I buy the stock at its current price of $62.65, which is 12 times earnings? I'd recommend this stock without hesitation. So finally, look at our past performance. The stocks that we've suggested you should buy. Again, we've had 3 stocks that we've suggested that you should buy in the last 5 months that we have already made a nice profit on and covered. Those are Altria Group, H&R Block, and Phillips 66. T. Rowe Price has created a nice return for us. AGX has done sort of the opposite. Martin Transportation is, again, a nice return. Apple is, up, but not up significantly. You kind of go down the list. The good news is we're profitable. I'm going to do a report in the next couple of weeks that talks about how we've done relative to the S&P 500, how we've done overall, do some bragging about our good stocks, eat some crow about our bad stocks. I haven't come up with exactly what we've done in terms of the S&P 500. I'm just really worried about trying to make intelligent decisions and hoping that over time those decisions will generate the returns we want. And again, because every week the amount of money that I've got invested has changed, I just have to spend some time to calculate exactly what my average holdings has been and what my profits have been and how that return has worked out. I don't think we're doing poorly relative to the S&P 500. I also don't think we're killing the S&P 500. But we've only been doing this for 6 months. And I'd like to have a year and a half to see how we're doing in general. So that's it for the report for this week. Thank you very much for your time. And please remember to subscribe and or comment as well as like. Thank you very much.